Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to look at my approach to investing. I know there was a question that was asked, kind of like an outline of how I approach. How do I approach investing? What takes priority? Is it ratios, market conditions? Is it the technical analysis? And I'm going to try to go through and describe my thoughts on all of it and my approach. And obviously, I tie in risk reward, I tie in portfolio allocation size, stuff like that. But I'm going to talk like big picture view. And, I started this channel August of 2020. I saw that there's going to be a large commodity bull market. I got real giddy. I was investing in uranium, investing in oil. I had put a lot in the beginning in precious metals mining companies in the bottom of March. The reason I did that is based off of history. Usually when they have a crash like that, what they do is they print a bunch of money. They put a bunch of stimulus into the system. When they put stimulus into the system, much like they did in 2008, you usually get a big move in gold and silver, accounting for the money supply increase that they created. So you get a large revaluation of basically all of that money coming into the system by gold right off the bat. Gold and precious metals, especially the monetary metals. So it'd be gold, silver, and the mining companies. That's when the mining companies do the best because oil hasn't taken off yet. Now, that's not me knowing ratios. It's not me necessarily knowing all that stuff. It's just me being observant of the markets and being in the markets for so many years. But the ratios were good for precious metals and the mining companies. So then that summer, I swapped over to uranium and oil in a big way because there was it was underinvestment from ESG. They thought that they, being just people in general, think that the renewables can take over fossil fuels. I don't think so. So I'm taking a bet against them. I'm essentially shorting government and all these people that think renewables are going to win because I don't think the energy returns and the mineral intensity, given what I saw in the future in the market balances of the materials, is going to be enough to support a renewable world or even a world where we try to make electricity storage. Maybe we can do hydrogen, but hydrogen's really hard to contain. Hydrogen is the smallest molecule. We would helium leak check weld joints and braze joints for aerospace type welding. So helium, which is a larger molecule, is very hard to control and maintain, and that's what we were checking our braze joints and weld joints with. So hydrogen, although it may be an energy dense way to store something, it's very hard to contain. It's also very energy intensive to create. So it'd be a huge net energy sink for a hydrogen economy or anything that's hydrogen related. So you're going to waste a lot of energy in the process creating it, electrolysis or whatever it is. Well, anyway, back on track, my approach. So what I saw to kind of spur me right in the beginning was two things. And I would say that it was ratios and market conditions combined that got me all jittery and goey and basically created this channel. So let me look. I'll show you those two things here. All right. The first one was the commodity to S&P 500. And what this is basically doing is the ratio is encapsulating everything that you want it to encapsulate. So I'll break it down. When it's low down here, and that's when I was looking at it, was 2020 in this basically bottom. And I was very early. You make a lot of money when you're early. This was at 100-year plus lows or all-time lows. It's never been this cheap. So what I was thinking back then is, this thing's at 100+ year low or an all-time low. And right now, the risk reward for commodities is probably the best it's ever been and ever will be in anyone's lifetime. That's alive today or even dead. So the risk reward was stating that all of the money was piled into stocks, and commodities was the most underinvested sector that there was in history. So I knew that there was an opportunity in commodities. The question was, what is going to turn this ratio around? What market condition turns this around? And looking at history, there's two things that turn around money flows from commodities to the S&P 500. One of them is an expansionary phase of real estate and a demographic that's larger coming to home buying years. And that's really what's basically got me into the commodity trade, was that it was a twofold thing. It was the stimulus that they created and handed to the people directly into their hands, which is going to be inflationary. That's going to show up in the consumer price index. That is going to put everything in a shortage. Too many dollars chasing too few goods equals inflation. We also had the millennials coming into home buying years, and we had a housing. This goes back to the housing thesis of the channel. We have the housing market, the housing starts coming into an expansionary phase. So whenever you go above this white line, you're in an expansionary phase. We're in an expansionary phase still. We've got some volatility. A lot of people are saying, oh, the housing market's going to crash and all this other stuff. Right now, I'm remaining open because we're still in an expansionary phase, and that has not concluded yet. And a lot of people are afraid. There's a lot of recessionary fears, but I'm not in that conclusion camp yet until we really break down below our uptrend and below all these support levels. Anyway, this was going into an expansionary phase in 2020 here. It was November 19, and then we went back up in 2020. I was like, the expansionary phase is going to be a tailwind behind commodities, and it's going to put pressure on interest rates to go up. Plus, with that stimulus money, it all aligned very well. I'm like, this is going to be inflationary. You can go back, look at my older videos, and you can see that I've been pretty much stable with my outlook in terms of inflation, higher interest rates, and all that stuff. So that's really what told me that the disinflation to inflationary environment was rotating, it was changing. And that is what I was looking at, was this housing starts. So it was housing starts and the CRB to S&P 500 ratio that got me all sorts of giddy here. And I just looked at the sentiment too. I mean, everyone is piled into NASDAQ. Everyone was doing these stupid cryptos and these stupid NFTs. I say stupid because it's absolutely retarded. Sorry for dropping all this, but I just thought, if this money's chasing all this stuff, we have way too much money in the system. And we're pretty fat, dumb, and happy when people are buying not even real stuff, just pictures of, JPEGs of pictures for millions of dollars. And there's a lot of people that bought into that too. I even saw Raoul Pal was bought into it, and Michael Saylor and all these other guys. And they all kind of jumped into that train. And that's fine, whatever. And I just couldn't jump on that train, guys. You've heard me from day one, non-crypto guy. I don't see where the asset is. Well, anyway, those are the two things that I really looked at. So then what I did is I looked at the leverage. So I'm going to pop in here real quick. I looked at the leverage of each sector. So I went back in history and looked at the leverage that each sector provided against gold. So I took the ratios and I said, okay, which ones compress the most over a commodity bull market? And there was some clear winners here. Oil does very well. Natural gas is a beast. Natural gas is one of the most volatile, most compressive commodities there is. Uranium was another one. And then of the precious metals, the two that stood out to me were silver and platinum. Now, I've been buying silver back in before 2018, 2017, because the ratios were just ridiculously cheap. 2019, and then I started buying more of platinum here recently, in 2019 and onward. So ratios of the individual commodities is what drawed me to it. Why was I drawn to those commodities? Because the CRB to S&P 500 ratio. So I looked and I said, okay, this is definitely looking like it's bottom. We've got the market conditions that are right for this to turn and go on up. And then I started looking at the sectors to see what leverage I could get to the price move. The clear winners, in my opinion, were oil, natural gas, uranium, and platinum and silver. Platinum is the one I like right now. Silver was the one I liked, a little whiles back, 2018, 2019, stuff like that. So those are the sectors that I thought had the best leverage to the moves that were coming up. So then I said, okay, well, what's a barrier to entry into these areas? And which ones, what do the supply demand fundamentals look like? What do the market balances look like? So that's what I looked at next. And what I saw across the entire commodity complex that we have major problems across everything, which then makes me think it's going to be even a more inflationary environment, because the relationship of where we are with debt and GDP becomes a problem. So that is what balances, that viewpoint that I have right there, balances how much money I put in physical metals versus how much I'm going to speculate in the markets. And that's kind of how I formed my opinions and what I did at the beginning of this bull market, and why I'm choosing these sectors. These sectors are also, if you look at history and you look at these sectors, oil is one of the biggest inflationary hedges. So if I think that we were going to come into a very inflationary time, what I needed to do is I needed to put a little bit more money towards what has been a very direct way to play inflation. So inflation is usually caused by two things, at least when I look at history, the majority of it. One is the increase in the M2 money supply. The increase in the M2 money supply at a faster pace than you can grow GDP is inflationary. That is where I looked at the housing starts and the loan growth. Credit growth is money supply growth. So the loans going against new homes in ever greater quantities is inflationary with a larger demographic. And we had all of that for the market conditions to turn. So we had a larger demographic, the millennials coming in home buying years, and then we had the expansionary phase of real estate going over the average, which means it's going to be a little bit more inflationary than before. Then we had the stimulus money that came into the system. All of those things tied an inflationary picture in my mind. So then, after we've got an inflationary market condition coming, and then we had the ratio screaming to buy a CRB to S&P 500, and the risk reward there was insanely good. So I went after the most beat down commodity at the time, and that was oil and natural gas. Oil, if you were to look at the ratio, and that's what I looked at. I looked at the ratio. If you were to look at a priority, I would prioritize the ratios and market conditions over technical analysis. Because when it's cheap, essentially you've got good risk reward, but you just don't know when it's going to turn. So you hedge yourself with time. But when we look at this, this is the ratio all back here. And even at like 50 is a ridiculous number, where it's an anomaly in history. If you take a long-term gold to oil ratio and you were to look at it, we rarely got above 30. 30 was kind of like our high point, 30, mid 30s. And we went all the way up here to this anomaly, no man's land. Now, whenever you watch commodities over time, what you see a lot of the times that the swing to the downside is going to come all the way back and swing to the upside in the opposite direction. And when you look at some of these, like if you look at these ratios over time, they're swinging larger and larger over time. So if you were to take the ratio behind me and you take like a big picture approach of it, you can see that the swings are getting bigger and bigger. You can also look at the Dow Jones to gold industrial average, and you can see the swings are getting larger and larger. These swings from ups to downs, and then up to down, which I think we're going to go way down here eventually. So what we're doing is the volatility in the system's getting larger and larger, means that the opportunities, I think, are getting bigger and bigger as well as money rotates and shifts around the markets, given certain market conditions. So from the analysis of the leverage of the commodities, natural gas and oil and uranium, I thought were the best bets. Now, how did I determine how I broke these all up? So what I did is I looked at the companies, and I really just wanted a huge leverage play to the price moves of the commodity itself. So I just wanted a bunch of leverage without using leveraged money. So I wanted to be unleveraged myself, but the company themselves could be leveraged up. They could have a lot of debt. I'm fine with that. But I knew I wanted staying power. I wanted to make sure that I could make it through the bottom, even through all the volatility. So I looked at all the companies, and of all of them, I thought that the best risk reward with the highest probability bets were mainly in natural gas and oil. The reason that is because they had infrastructure in place, and the companies were basically sold off from ESG, environmental social governance mandates, or whatever these funds were doing at the time, pushed these things all the way down, and some of them were very close to bankruptcy. So they were trading at pennies on the dollar in 2020 because of the oil prices and natural gas prices. So I took positions in them because it was a massive leveraged bet. What I mean by leverage, I'm not taking leverage myself. I'm saying that the companies had a lot of debt themselves, and they were sold off to pennies on the dollar. And if the commodity had shifted to the upside, they would move dramatically. So there was a lot of leverage to the price move of that commodity. It could have been 5x, 6x, 7x because of the conditions that the companies had gone under with oil being so low. And then everyone else was so bearish at the bottom, I kind of just do opposite. So that was oil, and that's why I overloaded oil or overweighted oil more than, say, uranium and some of these other sectors. It was because of the leverage to the price move, and it was because of the commodity going so far to the downside. And I think that it's going to go to the upside equally as imbalanced as it was to the downside. So we're getting these larger and larger swings with time. Uranium, I like that one as well. It has a ton of leverage to the price move, so I wanted to get a bunch in uranium as well, which I did. And that one, which made it a little bit more difficult, is a lot of the companies are highly speculative. It's like you're buying all these penny stocks. I didn't put as much money into those as I did in my oil and natural gas companies. The oil and natural gas, these were companies without dilution that were at $95 previously that sold off to $1. These were just ridiculously good opportunities. Uranium's the same way, but they diluted their shares a lot more, and they didn't have any income. And I couldn't see a clear path where a lot of these companies could have income. So I overweighted the oil and natural gas sectors. And I also saw back in the last bull market, I was more closely tied to natural gas and oil and watching those markets than I was uranium. So I had experience with it, and I knew that there could be 100 baggers and 1,000 baggers in oil and natural gas in very quick periods, like they had back in the mid 2000s. And that's kind of how I approached all of it. Now, when things get moving like we are, we're kind of mid-stride now, going up, and we're getting a consolidation pullback. The overall markets are definitely pulling back. That is something that I made comments about. I made comments about the potential for the overall markets to roll over, which I was expecting. A pullback in the S&P 500, and then a period where it gets difficult to know exactly how they're going to work with each other. Sometimes with the leverage in the system all leveraged up, it's going to pull us down with it. But at some point we would decouple and move. And I didn't know exactly how it would look, because you don't know if the markets are going to crash. You don't know if they're just going to be a slow grind lower. It's difficult to try to predict that type of movements, and I don't really want to be in the game of trying to predict it. I'm in the game of positioning and getting good, cheap share prices and then riding it higher. Especially if you bought the bottom of 2020, you're sitting pretty good no matter what the market does in the short term. So that's how I approached it. Now it gets more difficult because you've come off your bottom. You've already come off your bottom. You don't know when that consolidation is going to necessarily end. So my strategies change. In the beginning, I was kind of just find stock, look at the pattern, and then I was piling in more concentratedly. I needed to move more money into the market faster. Now I'm sprinkling more, because during consolidations, it can be kind of hard to figure out where exactly it's going to end. And I know people think they can predict this stuff. I don't think anyone really can with any sort of degree of certainty. That's why you don't see day traders being billionaires, because they just don't do very well. So I kind of change my strategies, and I sprinkle in because the volatility is going to be great as we go and we get locked up with the overall markets. And as it decouples and as we roll higher, it just gets a little bit harder. At least for me, it is. So, so that's how I'm kind of, my strategy is right now, is I'm just sprinkling money in. The companies I'm choosing is a mixture of fundamental analysis and technical analysis. Technical analysis is a way to objectively look at something without anyone else telling you anything. It's just pure price movements. And then I look kind of deeper, looking for momentum and velocity. So momentum is what I try to look for, and velocity of the movements. Looking at the candlestick sizes, it's something that I made up. I haven't read it in a book anywhere. I just kind of made a lot of this stuff up myself after looking at so many charts and watching the markets over the years. So when looking at this, I found companies based off of their kind of first bounces and did measured moves of their bounces. And I said, well, if these things move like an Elliott wave, if you get like a 1, 2, 3 kind of wave movement, which I didn't really know Elliott wave existed at the time. I just knew that there was movements and sizes of the patterns, and that larger sizes created bigger moves. So I looked at the size of the moves, and I just basically positioned in what I thought were the most leveraged companies in terms of the technical analysis and the moves going forward. And then I looked and researched the companies themselves. I looked at the CEO. I looked at YouTube. I looked at some things on YouTube of the company presenting, because some companies had presentations on YouTube at that time. I looked at their presentations on their website, and I said, I don't think they're going to go bankrupt. I think they're okay. And with the size of the fractals, I spread my money out and went big in which I thought were the best companies to do that in. So my position size was something that limited my risk. It wasn't me putting stop losses. It was my position size. And then I went long, and I went very long, and in a bunch of different companies that it turned out pretty well, at least for oil and natural gas. And that's kind of what I did to find it. So I did if you were to look at the order of sequence here, I looked at the overall big picture view of the CRB to S&P 500. And then I looked to see where we were in the business cycle, real estate cycle, which was an expansionary phase, which is usually inflationary. But I think this is the beginning of a very large inflationary period. If you were to look at yields, yields are breaking out of 40-year downtrends, which means we could have a 5 or 10-year up move in yields, and it's much more inflationary than the mini cycle we had in the 2000s. So there's other data that I look at. And really what I'm doing is I'm painting a picture. I'm putting a puzzle together, and the data is just stacking all up. And I'm using technical analysis to basically describe the picture. And, charts, just using charts. I don't use other people's opinions at all. It's all data, and then creating the narrative from the data, or creating the story, or creating what I think is the reasoning behind the move, which will give me even further, I can get in even further with more confidence, the better I can identify early entry points because of leading indicators. Leading indicators like the business cycle or the real estate cycle are useful. And knowing what the ratios are doing, if they're turning over, if they're bottoming, or if they're cheap in relationship to history. It's a combination of all of those things. If you have, and I were to ask, a question, you'd say, my question is, and I know a lot of people, they don't look at this stuff, so they're going to think, man, this is confusing, which I understand. But if you're at 100-year lows for a commodity at S&P 500, and commodities are cheap against all these other assets, it means you have the lowest risk to buy it at that time. And then if you were to comb through, and it just so happens that the greatest commodity leverage, the greatest leverage commodities in this bull market are going to be the lowest they've ever been in history, like oil and uranium. I mean, why not load up there? Why not take the most amount of risk at the best time? That's exactly when you want to do it. And that's exactly what I did. So it's, I mean, I don't know how to explain that. It's just risk reward and knowing when to pull the trigger. How do you know to pull the trigger at that exact time is, it was a good entry because of the risk reward. It was a good entry because I thought that the market conditions were going to change, but I didn't know with 100% certainty that it was necessarily going to play out that way. It was just a bet off of logic and looking at history. And that's all you have to go off of in the markets. And it just happened to turn out well. Now, I also researched and studied a lot in oil. So there's a reason that I'm an ultra bull in oil is because I've studied peak oil. And I'm not saying like I'm an expert in it, but I've read a lot about it. Back in the day, Richard Heinberg, Matthew Simmons, Colin Campbell, all those guys, if I can remember them all, they're big peak oil, guys. And, they may not be right with the exact timing of it, but the theory, I think, still applies. And at certain points, I think oil is going to get harder to get out of the ground. And you can see that we're going to further extents to get this oil all around the world. We're digging deeper. We're mining it out of oil sands. We're doing some crazy stuff. If it was so plentiful, we wouldn't be doing that. So at some point, when you're moving at an exponential speed upward, you're going to get into a problem where you hit a resource constraint. And you won't know it until it's right up on top of you. So you're moving so fast and you're exponentially growing that the delta that you need to bring online from where you're at today continues to grow. You need to bring more and more on to get that growth because you also have decline rates of the existing oil. So when I have an opportunity sitting at the front of an inflationary period and you've got the ratios signaling that oil and uranium's the cheapest it's ever been, I'm gonna load up because of what I know in the energy markets. And I'm an engineer. I know my opinion has always been energy runs everything, not money. It's energy. So if we were to get into a very tight period like the 1970s, this is your history that you've drawing on. I think that the 1970s were very inflationary, not because of money supply growth in its singularity. It's because we also had an energy crisis during that time. And the energy crisis is what translates dollars into the CPI. And this time, I think we're going into a global energy crisis, which means that more money is going to translate into the CPI because of energy. So that's that portion of it. And now, I'm looking, and my opinion is that we have to go into nuclear in a big way for the world. So I'm looking at this from a very big picture view. And I think that over the next 10, 20 years, uranium is going to do create incredible stuff. And we're going to have to build out nuclear, period. There's no other, there's not many other solutions at this time. We've kind of maxed out some of our hydro. We've kind of maxed out some of those other renewables that are somewhat reliable. And then you've got very mineral intense renewables. And I just don't think they're going to work with the incredibly mineral intense storage systems of electricity as well. So it's basically all coming to a point in energy. And if they're the largest, leveraged areas, and they are the cheapest they've ever been, it just was obvious to me. I don't know, it just seemed obvious. So that's kind of how I chose everything. It was based off of ratios, market conditions, and technical analysis. Technical analysis on how I chose my companies and my entry points, the market conditions of a disinflationary environment to an inflationary environment, looking at demographics and where we were in the business cycle, and then ratios telling the valuation of all these different companies, and then the leverage based off of historical ratio movements against assets against other assets, showing me what has the greatest leverage in a commodity bull market, which is natural gas and uranium. Oil's a close third. And then platinum being the most leveraged. Platinum and silver are the most leveraged in precious metals. And then I thought, well, in 1970s, we had a inflationary environment with an energy crisis, which also transpired with a potential currency crisis. People were very worried in the 1980, 1979 about a currency crisis. And I think that that could potentially come with this energy crisis as well on a global scale. What that means is that the largest returns that I can think of in the market are going to be under energy and under precious metals. Those are the two that I think can do the best. So what did I do is I bought physical metals because it's the least risk way to play this, and I bought a bunch of energy. At the bottom of 2020 and at 2021 and at 2022, the ratios are still cheap and they're still moving in a favorable direction for us. So priority-wise, I don't think anything is a higher priority. I think they're all important because they all are a piece of the puzzle. And I know this is a highly complicated puzzle and people are trying to time this on a short-term basis. I think trying to focus your efforts on timing the short term is just a waste of effort. I know some people are going to say, oh, look, I was right. It went down 20 or 30%. Guys, 50% pullbacks in commodities are normal. You don't know if your reasoning is necessarily right, but on the big picture view, if you can get the big picture right and you can hold through it, that's where you win. Now, there is another thing that I haven't mentioned in this. It's the debt in the system. A lot of people say, well, you know, that this debt's going to be deflationary. I don't think so. I think it's going to be massively inflationary. So I think the deflationary guys and the guys who think that the entire market is going to crash, I think are just wrong. So I think that we are going to go down in the short term. And I think we will get to a certain point where these countries they're going to rotate, they're going to flip, they're going to pivot, and they're going to start printing. They're going to print because what's going to happen is they're going to get in a bad situation, and they already have pivoted. Some of these central banks have. Europe, the euro, Europe has pivoted, and same with UK and some of these other ones. They pivoted and they started buying bonds because they can't have their bonds just crash and have pensions and these governments kind of go under. So I think they're going to be in there and kind of prop these things up. Quote, yield curve control. That's highly inflationary. And I don't think interest rates can get to a level where they all go bankrupt either because of the debt in the system. So I think they're going to print money, which will be inflationary, to buy bonds. So I think they're stuck. And when they're stuck like that, and everything they can do is basically just print money and have it be an inflationary outcome, then I want my precious metals very badly. Physical metals. You guys can speculate on, the mining companies or whatever, but I want the physical. That's what I want. And there could be a time where the physical, like the paper price, diverges from the physical price, which I already think is happening. And you're going to ask why? Why is that going to happen? Well, I mean, the physical metals is what everybody wants. And that's what I'm buying. I'm buying the physical metal. The problem here is the paper price, once people figure out that it's just paper and it's diverging from the physical, which is already happening. Look at the premiums of silver, look at the premiums of some of these items. It's going to diverge. And then what's going to happen is everyone's going to dump the paper market because they know that the physical doesn't back it. So you could see the paper markets diverge to zero while the physical market goes up to infinity. That could happen. So when people say, well, should I buy SLV or PPLT or some of these ETFs? Well, they trade to the paper market, right? So what happens if the paper market fails? And that's where I just don't want to play with it. Give me the physical metal. I'm out of the system. Good to go. So that is that's one outcome, potential outcome. Maybe not. Maybe they don't fail. Maybe they go up. I don't know. I don't know the answers, and I can't see the future, guys. This is not a prediction. I just said that could be a problem in the system if people figure that out, if they figure it out. So I think I did hopefully that was a good job of kind of walking you through how I approach the investment. And, I wouldn't say there's any priority. The sequence is figure out what the overall market is doing, the macro kind of picture, big picture view. And a lot of people are going to debate the big picture. This is my viewpoint, at least. It's not someone else's. Big picture view, this is what it looks like from people positioning in the markets. This is the technical analysis I used to see that positioning in the markets through ratios. I used the ratios and valuations. I looked at the leverage of each commodity, went into the highest leverage commodities, and then I looked at the companies that had the highest leverage of those against the commodity and entered what I thought was the best possible point in 2020 with a good chunk of money. And I've been adding ever since. So if you guys like this type of analysis, if you need help in this next commodity bull market, sign up. Oh, wrong way. Sign up to the finding-value.com, become a platinum member, ask me these questions. I'm free to answer. You can see my portfolio. You can see those stocks that I've selected. I talk a lot about the stocks at the platinum question and answer sessions, and a lot of people I think gain good information from it. Obviously, none of it's as advice. It's just my opinion. You can see what I'm doing, and that's all I can do. I can't do one-on-one coaching. I can't do any of that stuff. So I can't do any of that. But you can see what I'm doing. It gives you a glimpse into how I'm positioning, what I'm looking at. There's also trainings, technical analysis trainings, and all that stuff that I do. And it's going to be helpful for anybody who's a newer investor learning this. It's going to jumpstart you in a direction that hopefully will be very good for you. So, all right, guys, that's all I've got. Don't forget to click the thumb up button. Don't forget to subscribe to the channel, and we'll catch you next time. This is Finding Value.